Imagine buying into a business that is just structurally guaranteed to grow its earnings by 20% every single year.
Right, which sounds like an absolute dream.
Exactly. I mean, you look at the financial statements and the numbers are immaculate. The management team is celebrating. Wall Street is applauding.
Yeah.
But then, when you sit down at the end of the year to calculate your actual real-world wealth, like what you can actually go out and spend, you realize you are actively getting poorer.
It's completely wild. It just completely violates everything we are taught about how investing is supposed to work.
Right.
We're conditioned from day one to believe that a growing bottom line automatically equals wealth creation.
Yeah, we really like to treat corporate accounting like it's a medical x-ray or something.
Oh, that's a good way to put it.
Right, like there's this expectation of diagnostic precision. You look at the balance sheet, you see the earnings per share, and you assume, well, this is giving me a clean black and white picture of reality.
But the reality is that the financial diagnostic landscape is incredibly murky. I mean, standard accounting rules, as necessary as they are, they can just so often obscure the economic truth.
Absolutely.
What looks completely healthy on a balance sheet might actually be a business in terminal decline.
Yeah.
And conversely, a company that looks completely stagnant on paper might be quietly generating massive compounding wealth just beneath the surface.
So today we are peering behind the curtain of those financial statements. Welcome to the deep dive, by the way. Our mission today is to uncover the true economic reality of business.
Yeah, we've spent the past few weeks just totally immersed in this fascinating stack of historical letters.
Yes, the shareholder letters written by Warren Buffett, specifically the one spanning from 1977 to 1983, detailing the inner workings of Berkshire Hathaway.
And I should say right up front, while we are talking about a specific historical period, this is absolutely not a history lesson.
No, not at all.
This is really a masterclass in seeing through financial illusions. The value in dissecting this period isn't just about, gleaning hot investment tips.
Right.
It's a profound exploration of critical thinking, because these letters were written during one of the most volatile economic periods in modern history.
Yeah. The inflation alone was terrifying.
Exactly. And so they teach you how to separate accounting fiction from economic truth. And that is a vital skill.
Right. Whether you are managing a division at a Fortune 500 company or running a local small business, or just try and understand how value is actually created or destroyed in the broader economy.
It's about understanding the underlying mechanical laws of business rather than just blindly accepting the glossy numbers handed to you in a press release.
Yeah. So consider yourself the third person in this conversation today. Pull up a chair. We are going to challenge some deeply held assumptions, starting with the single biggest sleight of hand you will find in almost every corporate quarterly report.
Ah, yes.
The perpetual bragging about, quote, record earnings.
It really is the most ubiquitous headline in financial media. A company reports that its earnings per share are up, and it is universally treated as this triumph of managerial skill.
Right, but let's unpack the actual mechanics of how a company achieves those record earnings. Because if you read the 1977 letter, there is this palpable, almost visceral disdain for companies that trumpet record earnings per share simply because they retained earnings from the previous year.
Yeah, and when you stop and think about the math behind it, that disdain is completely justified.
Okay, so let's trace the flow of capital here.
Sure. So a company makes a profit. It basically has two primary choices, right? It can return that cash to the shareholders as a dividend.
Which people love.
Right. Or it can retain that cash and reinvest it back into the business.
Okay.
Now, if management chooses to retain the earnings, they are fundamentally increasing the capital base of the company.
Right.
The company is literally now working with more money than it was the year before.
Which means bragging about higher earnings the following year is, it's practically a mathematical default.
Exactly.
If I manage a massive corporate division and my board lets me keep all of last year's profits instead of paying them out, my total pool of resources has grown.
Right.
Of course my total raw earnings should go up. It's compounding. You just left the money in the machine.
Yeah, the crucial distinction to make here is that the true test of managerial performance is not the raw dollar amount of earnings.
Right.
Nor is it the simple growth of earnings per share. The true golden measuring stick is return on equity, or ROE.
ROE.
Right. Specifically, we need to look at operating earnings measured against the beginning equity capital for that year.
Okay, let's use a real corporate scenario to ground this,
Yeah.
because I think people easily get lost to the jargon of ROE.
Yeah, that's fair.
Imagine a logistics company. They have a fleet of, say, 100 delivery trucks. They have a great year and generate $10 million in profit.
A very solid year.
Right. But instead of paying that $10 million out to the owners, the CEO buys 25 more trucks.
Okay, expanding the fleet.
Exactly.
Yeah.
So the next year, the company announces record earnings of $11 million.
Yeah.
Wall Street cheers. The stock pops.
Because the number went up.
Right. But wait, they increased their fleet by 25%. They increased their capital base by 25%.
Yep.
But their profits only went from $10 million to $11 million. They only went up by 10%.
Right, so they are deploying capital way less efficiently than they were the year before.
Exactly. The raw earnings are at a quote-unquote record high, but the economic engine is actually degrading.
Yeah.
The CEO is working harder, managing 25 more trucks, dealing with more overhead, but they're generating a lower return on the underlying capital.
And this is exactly what happened to Berkshire in 1977, and they were brutally honest about with their own shareholders.
Oh, yeah, they didn't hide it at all.
Not at all. They reported that their operating earnings per share were up 37% from the previous year.
Which sounds incredible.
In a vacuum, yeah, a 37% jump in earnings is a headline-grabbing triumph. I mean, most CEOs would be demanding a massive bonus for that.
But they immediately deflated their own balloon.
They really did, because they pointed out that their beginning capital base was up 24%.
Right.
So when you increase the money you're working with by 24%, a 37% gain in earnings is still a positive outcome, obviously.
Sure.
But it is considerably less impressive than the raw 37% figure suggests. The focus has to be on how efficiently that capital is being deployed.
Okay, so what was their actual efficiency that year?
In their specific case that year, they achieved a 19% return on beginning equity capital.
19%.
Right. And that 19% is the number that actually matters. That tells you the true health of the economic engine.
It really forces you to reevaluate how we measure success, even outside of massive corporations. Think about a software startup.
Oh, startups are the worst offenders with this.
Exactly. A founder might brag that their annual recurring revenue doubled. But if they had to triple their marketing spend and dilute their equity by bringing in 3 new rounds of venture capital just to achieve that doubled revenue,
right,
are they actually building a better business? Or are they just, bloat scaling?
Are you measuring success by the raw dollars coming in the door, or are you looking at the efficiency of the underlying capital, whether that is cash, equity, or even human hours?
The allure of raw growth is a very powerful psychological trap for management.
It really is.
But if return on equity is the ultimate measuring stick for business health, we kind of have to talk about the environment in which that business operates.
I do.
Because the late 1970s and early 1980s introduced this silent, invisible force that constantly attacks that return.
Yeah.
It's a macroeconomic force that distorts reality so severely that it makes even fundamentally good businesses function like terrible investment.
Right. We have to talk about inflation.
The big bad wolf of economics.
Exactly. And specifically, the concept of the investor's misery index.
Oh, I love this concept.
It's a framework that just fundamentally alters how you view corporate profitability and wealth creation.
Okay, so the misery index is defined here as the combination of the inflation rate plus the percentage of capital paid in taxes.
Right.
And we are talking about both the income tax on dividends and the capital gains tax on stock appreciation.
The interaction between high inflation, taxation, and corporate returns, it just creates a deeply toxic environment for the owner of the capital.
It really does.
Let's walk through the hypothetical scenario laid out for 1979 because the mechanics of this are so vital to understand.
And the math on this is just brutal. Let's set the stage.
Okay, so imagine an economy where inflation is running at 12%.
Okay.
Now, imagine you own shares in a truly excellent business. This company consistently earns a 20% return on equity.
Which is huge. In the real world, very few companies can consistently hit a 20% ROE without using dangerous amounts of leverage.
Right, so on paper, this is a phenomenal elite business.
A total goldmine.
Now, Assume this elite business distributes all of its earnings to you, the investor, in the form of dividends.
Okay.
And because of the tax code at the time, let's assume you are in a 50% tax bracket.
Which, just for context, was completely standard for a high earner back then.
Right. So the company earns 20%. Half of that return immediately goes to the government in taxes.
Right.
So you are left with a 10% nominal return in your pocket.
Okay, 10% cash in hand. Not bad at all.
But remember the environment. Inflation is running at 12%.
Oh, man.
That means the purchasing power of every dollar you hold has shrunk by 12% over the course of the year.
So you gain 10% in nominal after-tax dollars,
Yeah.
but the cost of the goods and services you actually want to buy went up by 12%.
Exactly. You were actually in the red by 2%.
Wow.
You lost real purchasing power. You actually became poorer by owning one of the most profitable elite businesses in the entire country.
That is the part that just bends the mind. You own a cash-gushing machine, it operates perfectly, it dominates its market, and the macroeconomic environment still bankrupts you slowly.
Yeah.
And there is a devastating irony here. The investor in that 1979 scenario would actually be far better off in an economy with completely stable prices, like zero inflation owning a mediocre business that only earns a tiny single-digit return on equity.
Absolutely. Because in a zero inflation environment, even a 5% after-tax return actually increases your ability to consume. Real wealth is created.
Right.
Inflation just destroys the utility of high returns.
But let me push back on this scenario for a second.
Okay, go for it.
If inflation is raging at 12%, and I know that any dividend I receive is going to get taxed at 50% and then eroded by inflation,
Right.
why would I ever want the company to pay me a dividend?
That's a good question.
Right. Like, I would just call up the CEO and say, keep the money, don't trigger a taxable event for me, just retain those earnings and reinvest them to grow the business.
And that is the logical, rational response from an investor trying to protect their capital.
Right.
But this is where we uncover the true insidious nature of inflation at the operational level. It isn't just a phenomenon that affects the consumer at the grocery store,
Yeah.
It fundamentally alters corporate cash flows.
Because the company can't just take those retained earnings and use them to launch new products or conquer new markets. They are trapped by what is described as the corporate tapeworm.
Yes, the tapeworm analogy. It's incredibly vivid and mechanically accurate.
It really is.
Inflation acts as this gigantic parasite inside the business that preemptively consumes investment dollars. It eats the cash just to maintain the exact same physical volume of business.
Let's walk through the mechanics of the tapeworm, just to make it really concrete.
Sure.
Say I own a manufacturing company, and I'm selling 1 million widgets a year,
Okay.
and inflation is running at 12%. Well, the cost of my raw materials skyrockets. The cost to hold my inventory skyrockets. When my delivery trucks break down, the replacement parts cost dramatically more.
Yeah.
When my factory roof leaks, the repair bill is higher.
And crucially, standard accounting depreciation does not cover those inflated replacement costs.
Oh, right.
Because depreciation is based on what you paid for the asset in the past, not what it costs to replace it today.
Exactly. So I have to take all those profits, the profits I originally wanted to retain just to avoid taxes,
Yeah.
and I have to pour them back into the company, not to grow, not to figure out how to sell 2 million widgets.
No, just to survive.
Right. I have to pour all my profits back into the business just to keep selling the exact same 1 million widgets. I am basically running on a treadmill that keeps speeding up, and I have to spend all my energy just to stay in the exact same place.
And this creates a profound paradox regarding rational economic behavior.
How so?
Well, in a normal environment, the rules of capital allocation are simple. You don't throw good money after bad.
Right.
If you own a bond paying 5% and interest rates rise so that you can now buy similar bonds paying 10%.
You don't keep buying the 5% bond.
Exactly. You don't take your 5% coupon payments and reinvest them into more 5% bonds. You redirect your capital to the higher yielding asset.
You starve the bad investment and feed the good one.
Exactly. But inflation flips that rational behavior completely upside down for businesses.
Okay, unpack that.
In an inflationary environment, a structurally bad business, meaning a business with a consistently low return on equity, is forced to retain every single nickel of earnings just to survive.
Wow.
It cannot pay dividends to the owners because the tapeworm is consuming all the cash just to keep the factory doors open.
So the capital basically becomes a hostage.
It does.
Yeah.
The owners want to extract their cash and deploy it elsewhere, right?
Yeah.
But the business requires constant increasing infusions of capital just to maintain its meager existence. It traps the capital in a low return environment, destroying owner wealth from the inside out year after year.
Which naturally forces us to define what a quote-unquote bad business actually looks like in the real world.
Right.
Because we aren't just talking about abstract theories here. The historical record of Berkshire Hathaway during this period provides a front-row seat to a brutal reality check.
It really does.
And that is the stark, undeniable contrast between the underlying economics of their textile operations versus their insurance operations.
The juxtaposition is fascinating, mainly because it completely eliminates management quality as a variable.
Oh, that's a great point.
You have Berkshire's historical foundation, the textile mills in New England, operations like the Wambeck Mills purchase,
Right.
and then on the completely opposite end of the spectrum, you have their insurance operations, primarily National Indemnity, and later their massive defining investment in GEICO.
What I find so compelling is that the failure of the textile business was absolutely not a failure of human effort.
No, not at all.
The managers are explicitly praised in these letters. They talk about executives like Ken Chase, who is energetic, straightforward, and highly competent.
Right.
They point out that the labor unions were cooperative and reasonable. The workforce was dedicated. Everyone labored mightily to make it work.
Yeah.
But despite all that exceptional human capital, the textile operations produced completely miserable returns on the money invested.
Because superior human effort simply cannot overcome fundamentally flawed industry economics.
Let's analyze the mechanics of the textile industry at that time.
Sure. It is a textbook commodity business. First, it is highly capital intensive. You require massive, expensive factories filled with incredibly expensive looms and machinery.
Okay.
Second, the global market suffers from persistent overcapacity. There are always too many mills producing too much cloth.
And the real fatal flaw is the product itself, right?
Exactly. There is no way to meaningfully differentiate the product.
Yeah.
A yard of standard broadcloth is a yard of standard broadcloth. When a garment manufacturer buys cloth, they do not care about the rich heritage of the New England mill that wove it.
They don't care about the cooperative labor unions either.
Not at all. They care about one metric: the price.
You mentioned a phrase earlier when we were reviewing the sources that I think is critical here.
Oh, right.
Unadministered prices. Let's make sure we are totally clear on the mechanism of what that means, because it really dictates the survival of the business.
It is a brutal economic reality.
Yeah.
In a market with administered prices, think of a monopoly or an industry dominated by 2 or 3 massive players.
Like utilities, maybe?
Yeah, exactly. Those companies can look at their rising costs, look at the inflation rate, and simply dictate a higher price to the consumer. They administer the pricing, they just pass the burden along.
But in textiles.
In a fragmented commodity market with persistent overcapacity, you have unadministered prices. You are a price taker, not a price maker.
Oh, man.
If your costs go up, you cannot simply raise your prices because there is always a competitor in another country willing to sell at the lower market rate just to keep their machines running.
Right.
The economic law is ironclad. Persistent overcapacity combined with unadministered prices equals structurally poor profitability. There's no escaping it, no matter how hard you work.
The realization here is that, as the quote goes, turnarounds seldom turn.
Yeah.
I mean, Berkshire bought Wambeck Mills at a massive discount. They bought it at a fraction of its book value. They practically got the physical machinery for less than nothing.
Right, and the thinking was, at this price, it has to be a bargain.
Exactly. But a bargain price tag on the entry fee doesn't fix a fundamentally flawed industry structure.
No, it doesn't. A cheap purchase price does not change the fact that the business will continually require massive capital expenditures just to stay competitive, all while generating zero pricing power.
It's like entering a marathon wearing lead boots and bragging that you got the boots on clearance.
That's a perfect analogy.
Good management in a bad business is just fundamentally tragic. You have these brilliant executives spending their entire careers fighting structural decline. Conversely, good management in a good business is like having a massive perpetual tailwind. You want to allocate capital to businesses where the tailwinds prevail.
Which brings us directly to the insurance side of the equation, and specifically the crisis and recovery of GEICO.
This is such a fascinating case study.
It is. In the mid-1970s, GEICO was teetering on the absolute edge of bankruptcy. Superficial market analysis at the time labeled GEICO as a classic turnaround situation, basically lumping it into the same category as a struggling textile mill.
But structurally, they were universes apart.
Completely different species of business. GEICO was not a bad business suffering from industry decline. GEICO possessed a fundamental, structural, and incredibly hard-to-duplicate economic advantage.
Their distribution model.
Exactly. They were designed from the ground up to be the absolute low-cost operator in the massive mandatory auto insurance market.
Because they sold directly to the consumer through the mail and over the phone, completely bypassing the traditional highly expensive agency system.
Yeah.
While other insurance companies were paying massive commissions to local agents, GEICO was keeping those costs internal and passing the savings on to the driver.
And that structural advantage is paramount. Even when the company was hemorrhaging money, mispricing its policies, and facing regulatory insolvency, that underlying low-cost structural advantage remained completely intact.
So the core engine of the business was flawless.
Exactly. The problems they were facing weren't systemic to the model, they were operational errors. They had misjudged inflation and wildly underpriced their risk.
So it wasn't a dying industry, it was just bad driving, basically.
Right. The situation is described in the letters not as a systemic failure, but as an excisable cancer.
Why?
The patient was fundamentally strong, it just needed a highly skilled surgeon.
Enter an executive named Jack Byrne.
Right. He came in, exercised ruthless discipline, raised prices, cut unprofitable lines of business. He literally cut out the cancer and allowed that incredibly healthy, low-cost structure to thrive again.
So it was not a true turnaround of bad business.
No, it was the rescue of an incredible franchise that had temporarily lost its discipline.
So if textiles represent the structural headwind, and a direct-to-consumer model like GEICO represents the structural tailwind, it's easy to assume that the insurance industry as a whole is a brilliant place to allocate capital.
Well, you would think so.
But the historical reality is far darker. The insurance industry is incredibly prone to extreme cyclical self-delusion.
It really is.
And this delusion is perfectly masked and in many ways actively encouraged by the rules of standard accounting.
This is perhaps one of the most critical and complex insights we need to unpack today. We have to look at the intersection of high inflation, insurance operations, and bond accounting.
Okay, let's walk through the mechanics of the insurance business during the high inflation environment of the late 70s and early 80s.
Sure.
Because on the operational side, insurance companies were actually behaving somewhat rationally in response to inflation.
Yeah, they were trying to protect themselves. Because inflation was so unpredictable, it became totally impossible for an actuary to predict what the cost of repairing a smashed fender or paying out a medical bodily injury claim would be 12 months into the future.
If inflation jumps to 15%, the premium you collected today won't cover the body shop bill next year.
Exactly. So logically, insurance companies largely abandoned the 12-month auto policy. They shifted the entire industry towards 6-month policies.
Okay.
This allowed them to reprice their risk twice a year, staying slightly ahead of the inflationary curve.
Which makes total operational sense. You shorten your liability window.
Right.
But the fatal flaw occurs on the other side of the balance sheet. They took the cash premiums they collected from those short-term 6-month liabilities, and what did they do with it?
They turned around and invested that cash into 30 to 40-year fixed-rate bonds.
It is genuinely mind-boggling when you say it out loud.
It's insane.
They recognized that the world was too volatile to lock in their premium income for more than 6 months, but they willingly locked in their investment returns for 4 decades.
It is a massive systemic duration mismatch, and the consequences in an inflationary environment are devastating.
Walk us through what happens when inflation spikes.
Well, when inflation spikes, central banks respond by spiking interest rates. And the fundamental mathematical law of bonds is that when interest rates go up, The market value of existing lower-yielding bonds plummets.
Because nobody wants to buy your old bond yielding 5% when they can buy a brand new bond yielding 10%.
Exactly.
You have to discount the price of your old bond to make it attractive.
So, as interest rates climbed into the double digits during this period, these major insurance companies were sitting on billions of dollars of long-term bonds that were massively, deeply underwater.
Yikes.
Their asset portfolios were financially bleeding out.
But if you looked at their published financial statements,
Huh?
you wouldn't see the blood. They didn't have to report those massive losses.
Right. And that is the magic of the accounting loophole known as amortized cost.
Let me play devil's advocate for the accountants here for a second.
Go for it.
If we force an insurance company to mark its bond portfolio to market every single day, wouldn't that create massive artificial volatility?
Well, yes.
Like if an insurer buys a 30-year U.S. Treasury bond and they fully intend to hold it for 30 years and they know the U.S. government is going to pay the face value at maturity, why should they have to declare bankruptcy in year 3 just because Paul Volcker hiked interest rates?
Right.
Isn't amortized cost accounting designed to prevent exactly that kind of panic?
Theoretically, yes. The defense of amortized cost accounting is that if you have the ability and the intent to hold the bond to maturity, the interim market price fluctuations shouldn't matter.
Right.
The accounting rule allows you to carry the bond on your balance sheet at the price you paid for it, gradually adjusting it, and basically ignoring the market crash.
So what's the problem?
The fatal flaw in that defense is the word ability. Do you actually have the ability to hold that 30-year bond to maturity? The reality is that if these insurers actually had to value these bonds at current market prices, it would have completely wiped out the stated net worth of many major household name insurance companies.
Why?
They were functionally insolvent. Their liabilities vastly exceeded the market value of their assets. They only appeared healthy because the accounting rules allowed them to project an illusion of solvency.
Which leads to a massive behavioral distortion. Let's trace the causality here, because this is where a boring accounting rule destroys the operational discipline of an entire industry.
Okay.
If I am the CEO of an insurance company and inflation is raging, and I know my bond portfolio is secretly underwater, my rational response should be to pump the brakes.
Right.
I should stop writing new auto policies if the prices are too low to make a profit. I should shrink my volume and wait for a better environment.
But you cannot shrink. You are trapped by a phenomenon called cash flow underwriting.
Walk me through the mechanism of this trap.
If an insurer exercises discipline and stops writing underpriced policies, their total premium volume shrinks.
Okay.
If premium volume shrinks, the total amount of cash coming in the door decreases. However, insurance has a long tail. You still have to pay out cash every single day for the claims on the policies you wrote last year and the year before that.
The claims department is still writing checks, even if the sales department has started bringing in new money.
Exactly. So where does the cash come from to pay those old claims? If new premiums aren't covering it, you have to dip into your asset pool. You have to liquidate investments. You have to sell those 30-year bonds.
Oh, and the second you sell the bond, the protective shield of amortized cost accounting evaporates.
Precisely. The realization principle kicks in. Selling the bond forces you to recognize the actual market loss on your income statement.
Because it's a realized loss now.
Right. And recognizing those massive accumulated losses would instantly decimate the company's published net worth. It would trigger regulatory intervention, panic among policyholders, and lead directly to formal insolvency.
It's a total house of cards.
Yeah.
So what is the CEO's only option for survival?
The only option is to ensure that new cash keeps coming in the door faster than old cash is going out.
Wow.
And to do that, they are forced to keep selling bad insurance policies at rock-bottom, unprofitable prices. They deliberately underprice their product just to maintain market share and keep the premium cash flowing.
They are operating at a deliberate underwriting loss. It is functionally a legal Ponzi scheme.
It really is.
They are relying on today's underpriced premiums to pay yesterday's inflated losses, all to avoid selling a bond and triggering an accounting reality check.
And the tragedy of this dynamic is the collateral damage. As long as these functionally insolvent zombie companies are forced to write business at any price just to generate cash, they drag the entire industry down with them.
Because no one can compete with those prices.
Exactly. Even the highly disciplined, fundamentally sound insurance companies are forced to lower their prices to match the irrational behavior of the zombies. Otherwise, they lose all their customers. A rule designed to smooth out volatility ends up destroying the economic rationalism of the entire sector.
Standard accounting rules can clearly hide terrible destructive disasters like underwater bonds.
Yeah.
But the mirror image of this is equally true and far more lucrative for those who understand it.
Okay, yes.
Standard accounting can also completely obscure the most brilliant wealth-generating investments a company makes. This brings us to the phenomena of the iceberg of non-controlled ownership.
This is an area where the rules governing corporate ownership percentages create massive disconnects between reported figures and economic reality.
Let's break down these ownership tiers because the logic breaks down at the extremes.
Okay, so if a corporation acquires more than 50% of another company, the accounting rules are straightforward. You have effective control. Therefore, you must consolidate their financials into yours. You report 100% of their sales, 100% of their expenses, and 100% of their earnings on your own income statement, with a minor adjustment for the minority interest you don't own.
You treat it as an integrated part of your empire. That makes sense.
Now, step down a tier. If you own between 20% and 50% of a company, the rules mandate the equity method.
Okay, how does that work?
You don't consolidate their top-line sales, but you do report your proportional share of their bottom-line earnings on a single line item on your income statement.
So if the target company earns $1 million and I own 30% of their stock, I get to report $300,000 of earnings on my books, regardless of whether they actually sent me a dividend check or retained the cash.
Correct. The accounting assumes that with a 20% to 50% stake, you have significant influence over the company's capital allocation, so it's fair to claim your share of the earnings.
Okay, again, let me play the role of the regulator. I can understand the logic there.
Sure.
But what happens when we drop below the 20% threshold?
Below 20%, the accounting methodology drastically shifts to the cost method.
And what does that mean?
Under this rule, you are only allowed to report the actual dividends that the target company pays to you in cash.
Just the dividends.
Just the dividends. The vast majority of their earnings, the undistributed or retained earnings that they keep to reinvest and grow the business, are completely invisible on your income statement.
And again, from the perspective of the Financial Accounting Standards Board, I see the rationale.
Yeah.
If I only own 5% of a massive corporation, I have zero voting power to force the CEO to issue a dividend. I do not control that cash.
Exactly.
Therefore, I shouldn't be allowed to pad my own company's P&L by claiming earnings that I have no legal right to access. If I can't spend it, I shouldn't report it.
And from a strict short-term cash flow perspective, the regulators are completely correct. You cannot spend retained earnings. But from a long-term economic value perspective, this rule creates a massive structural distortion of a company's true worth.
And the scale of this distortion is just staggering when you look at the historical numbers. In 1982, Berkshire Hathaway owned significant but sub-20% stakes in several massive, highly profitable businesses.
Yeah, let's look at the numbers.
Just isolating 4 of them: GEICO, General Foods, the Washington Post, and R.J. Reynolds Berkshire's proportional share of the undistributed retained earnings from those 4 companies was over $40 million for the year.
And because of the 20% rule, that $40 million existed in an accounting black hole.
Wow.
It did not appear anywhere in Berkshire's reported operating earnings.
To put the scale of that invisible wealth into perspective, that hidden $40 million was actually larger than Berkshire's entire total reported earnings for that year.
Over 50% of the true economic value being generated by the corporation was completely hidden from anyone casually reading the headline financial figures.
That's incredible.
The intrinsic wealth of the company was compounding silently, completely off balance sheet.
It is the ultimate iceberg analogy.
Yes, exactly.
It's like owning a massive commercial apple orchard. The trees are growing 10 feet a year, expanding the canopy and producing thousands of tons of fruit.
Right.
But because you only choose to take one single basket of apples to the farmer's market to sell for cash, your accountant reviews your books and declares your agricultural empire is practically worthless.
Right, because they only count the basket.
Exactly. The accounting system only acknowledges the tiny tip of the iceberg, the cash dividend, while ignoring the massive, compounding intrinsic wealth growing beneath the surface.
The crucial insight here is that the economic value of those retained earnings to the minority shareholder is not determined by the arbitrary percentage of the stock they own.
Okay, what is it determined by?
The value is determined entirely by how effectively the management of that underlying company puts that retained cash to work. If General Foods retains the cash, and uses it to launch highly profitable new product lines, the intrinsic value of Berkshire's 5% stake grows immensely, regardless of what the accounting rules say.
And this accounting blind spot creates a profound structural opportunity for value-oriented investors.
Absolutely. Because the broader stock market is often obsessed with short-term reported earnings.
Yeah, the headline numbers.
Exactly. When companies have massive retained earnings hidden by the 20% rule, the market often underprices their stock.
So you can buy them cheap.
Right. You can utilize the auction-driven nature of the stock market to buy fractional shares of phenomenal wealth-generating businesses at huge discounts to their true intrinsic value.
Which is just wild to think about.
Over time, as those hidden retained earnings are put to work, the business grows, cash flows increase, and eventually the market is forced to recognize that value. And that translates into massive capital gains for the patient investor.
Which poses a deeply logical, almost frustrating question. If buying small, 5% or 10% fractions of amazing businesses at a discount in the public stock market is so lucrative and requires virtually no operational effort,
Yeah.
why are corporate managers so obsessed with buying 100% of companies?
Yeah.
Why deal with the massive headaches, the integration issues, the cultural clashes of taking over an entire corporation, especially when it almost always requires paying a massive premium over the market price?
That paradox brings us directly into the psychology of corporate acquisitions, a phenomenon perfectly described as the acquisition follies.
Because the motivations behind most massive corporate mergers rarely have anything to do with maximizing shareholder value.
No, they really don't. There are three primary unspoken motivations that drive corporate leaders to pursue high premium takeovers, even when the financial math clearly indicates it will destroy value for their current owners.
Okay, let's go through them.
The first motivation is simply animal spirits.
The thrill of the hunt.
Exactly. Business leaders are naturally competitive-driven individuals. They relish activity. Buying a massive company is exciting. It generates headlines.
Right.
Sitting in an office quietly buying 4% of a publicly traded stock on the open market is boring. It doesn't get you on the cover of business magazines.
The second motivation is the flawed yardstick of success.
Yes. Most organizations and the executives who run them instinctively measure their importance by size rather than by efficiency or profitability.
Yeah.
They look at total gross sales, the number of employees, the global footprint of their real estate.
If you are a CEO at a dinner party, it is a lot more prestigious to casually mention that you oversee a $50 billion global empire with 100,000 employees.
Much better than explaining that you run a highly efficient, boring $2 billion company that generates a massive return on capital.
Ego demands scale.
But the third motivation is perhaps the most psychologically complex and economically destructive. It is the princess and the toad syndrome.
I love this metaphor because it perfectly captures the hubris of the C-suite. Explain the syndrome.
So, corporate managers frequently identify a target company, the toad. This target is usually a mediocre business, perhaps struggling with structural industry issues like our textile mill example.
Okay.
But the acquiring managers are supremely, serenely confident in their own managerial brilliance.
Of course they are.
They believe that their unique operational skills, their quote-unquote managerial kiss, will magically transform the struggling toad into a highly profitable, handsome prince.
And the historical record of these transformations.
As the old joke goes, we have observed many kisses but very few miracles.
Yeah.
The corporate backyards of America are knee-deep in unresponsive toads. The acquiring company pays a massive premium, applies their managerial kiss, and discovers that bad industry economics will defeat brilliant management almost every time.
But the true tragedy of the acquisition follies isn't just that managers buy bad companies. The most destructive element is how they choose to pay for these unresponsive toads.
This is critical.
I want to zero in on the financial mechanics of issuing stock for acquisitions, because this is where the permanent destruction of owner wealth really occurs.
The math behind issuing stock for acquisitions is brutal, and it is routinely ignored by management teams eager to close a deal.
Let's construct a scenario to illustrate the wealth transfer. Let's say you own a company, and the true intrinsic economic value of your business is $100 per share.
Okay.
But the stock market is in a slump, and your shares are currently trading at $50. Your stock is significantly undervalued.
Right.
Now, your CEO decides they want to buy a target company, a toad, and the target company is fully valued by the market. It's priced exactly at what it's worth.
If your CEO decides to pay for that acquisition by issuing new shares of your undervalued stock, they are committing financial malpractice against the existing owners.
Because to buy $1 worth of the target company, they have to give away $2 of your intrinsic value.
Yeah, exactly.
You are literally diluting the wealth of your existing shareholders to enrich the shareholders of the company you are acquiring.
Yeah.
It is like an amateur gold miner trading away chunks of solid gold, mistakenly pricing them as lead, to buy fully priced silver from a competitor. You are impoverishing yourself to make the transaction happen.
And yet this happens constantly. Why do intelligent managers rationalize this explicit wealth destruction?
Good question.
Because they utilize a sleight of hand in their financial modeling. When management pitches a merger to their board, they usually calculate the dilution of the deal based purely on short-term reported earnings per share.
The X-ray machine is broken again.
Exactly. If the complex accounting of the merger makes the combined earnings per share tick up slightly in the first year, management declares the acquisition a massive synergistic victory.
Unbelievable.
They completely ignore the permanent destruction of long-term intrinsic business value. They have surrendered partial ownership of a superior wealth-generating engine to acquire a mediocre one, all to make a short-term accounting metric look favorable to Wall Street analysts.
So if chasing turnaround toads and issuing undervalued stock is the blueprint for destroying wealth, what does the exact opposite look like?
Yeah, what's the gold standard?
If we want to find the perfect acquisition, an economic engine with massive structural tailwinds, where do we look?
You look past the boardrooms of Wall Street and you look to Omaha, Nebraska. You look at the story of Rose Blumpkin and the Nebraska Furniture Mart.
This is one of the greatest entrepreneurial stories in American history, and it serves as the ultimate counterexample to everything wrong with the Acquisition Follies. Let's talk about Mrs. B.
Rose Blumpkin immigrated to America with absolutely nothing. She had no formal business education. She barely spoke English when she arrived.
Right.
In 1937, she took $500 and started a furniture store in the basement of a pawn shop.
And she didn't just build a business. She went to war with the established retail industry. The massive established furniture retailers in Omaha were terrified of her pricing strategies, so they utilized every anti-competitive tactic available.
They organized boycotts.
Yeah.
They pressured the major national furniture manufacturers to cut off her supply lines.
They even hauled her into court, accusing her of violating fair trade laws by selling merchandise below the manufacturer's suggested retail price.
And my absolute favorite detail of her entire biography.
Oh, this is the best part.
She represents herself in court, absolutely destroys the opposition's arguments, wins the case, and then proceeds to sell the presiding judge $1,400 worth of carpet at the conclusion of the trial.
She was an unstoppable force of nature.
Truly. By the time Berkshire acquired a massive stake in the business in 1983, Nebraska Furniture Mart was generating over $100 million in annual sales from a single 200,000 square foot location.
Which is insane.
It was outperforming the combined sales of all other competitors in the region.
But the personality of Mrs. B, as legendary as it is only half the story. We have to analyze why the Nebraska Furniture Mart represents the ideal business from a purely structural economic standpoint.
Right.
It's the perfect antithesis to the struggling New England textile mills.
Because it wasn't built on a patent. It wasn't a monopoly. She didn't invent a new type of sofa.
Exactly. The structural advantage was entirely operational. Her business model was built on providing overwhelming, undeniable value to the customer.
Through a fanatical, almost pathological dedication to cost consciousness.
Yes, she minimized every single operational expense. She didn't have plush offices. She negotiated ruthlessly with suppliers.
And she bought inventory brilliantly, taking advantage of bulk discounts and off-season pricing.
Right.
Because she kept her internal costs incredibly low, she was able to pass those massive savings directly to the consumer in the form of rock-bottom prices.
Which creates a powerful, self-reinforcing economic flywheel.
The low prices generated massive, unprecedented volume. That massive volume gave her even more negotiating power with suppliers, allowing her to buy even cheaper.
Which allowed her to lower prices even further.
Exactly. It is a virtuous cycle that creates an impenetrable structural moat. Competitors couldn't match her prices because they couldn't match her volume, and they couldn't get her volume because they couldn't match her prices.
This is the ultimate defense against the commodity overcapacity trap we discussed with textiles. She took a commodity product furniture and built a structural monopoly based purely on operational excellence.
And look at how Berkshire handled the acquisition. It was the anti-acquisition folly.
Oh, totally.
They did not issue undervalued stock to buy the company. They paid in cash. And crucially, they did not dispatch a team of MBAs from headquarters with clipboards to integrate the company and, fix operations.
They bought 90% of the business, handed Mrs. B a check, and left her completely in charge.
At the time of the acquisition, she was 89 years old, working the floor 7 days a week, zipping around on a motorized cart selling carpet.
That's amazing.
They recognized that the managerial magic was already there, and their only job was to stay out of the way.
That decision to leave operational control entirely in the hands of the founders perfectly encapsulates a broader, overarching philosophy that permeates these letters.
Which is?
A deep, fundamental respect for the operators of the business and the owners of the capital.
Which connects directly to another fascinating, highly unusual structural detail regarding how they handled corporate charity. Let's talk about the shareholder designated contributions program because it challenges a massive assumption about corporate governance.
It forces us to ask a very basic question. Whose money is it?
Right. In a typical major publicly traded corporation, the CEO and the board of directors use company funds to make massive charitable donations.
Yeah.
And invariably, those donations flow to the CEO's favorite charities, their own alma mater, or the local hospital board they happen to sit on.
The CEO gets to play the role of the grand, magnanimous philanthropist, receiving awards and attending galas. But they are funding their social prestige using the shareholders' money.
The argument presented is that this system is fundamentally presumptuous and incorrect. The retained earnings belong to the owners, not the managers.
Makes total sense.
Therefore, Berkshire instituted a radical program where the shareholders themselves were given the power to designate exactly which charities received the corporate funds in direct proportion to the number of shares they owned.
It is the ultimate democratization of corporate capital, and the response from the investors was incredible.
They saw a 95.6% participation rate in the program.
Wow.
People loved it because, for perhaps the first time in their investing lives, they were being treated not as anonymous, transient stock flippers, but as actual true owner partners of the enterprise.
If you synthesize these disparate data points, the cash acquisition of Mrs. B and the refusal to meddle in her operations, the radical implementation of the shareholder-directed charity program, and another striking detail, the fact that at the time, Berkshire's entire corporate headquarters was a mere 1,500 square feet, staffed by only 5 employees.
That is astonishing. A company generating hundreds of millions of dollars in revenue, managing massive insurance floats and industrial operations, and the head office is the size of a modest suburban apartment.
All of these elements are manifestations of a singular, unifying corporate philosophy.
Yeah.
The extreme decentralization, the tiny headquarters, the refusal to issue cheap stock for acquisitions. It all proves that the management views the corporation merely as a conduit for shareholder wealth.
It is not a monument to managerial ego. They are not interested in building a bloated empire with massive HR departments and sprawling corporate campuses.
Right.
Their singular, ruthless focus is on finding capital and allocating it to its highest possible return while treating the providers of that capital as true partners.
It is such a profoundly refreshing contrast to the ego-driven corporate empire building that defines the Acquisition Follies.
It really is.
Well, we have covered a massive, complex landscape of economic reality today. We started by debunking the pervasive illusion of record earnings and identifying return on equity as the true measuring stick.
Yep.
We exposed the invisible, terrifying corporate tapeworm of inflation that eats away at real purchasing power and traps capital in bad businesses.
We did.
We navigated the treacherous mirage of amortized bond accounting and a Ponzi-like trap of cash flow underwriting in the insurance sector. We mapped the hidden, wealth-generating iceberg of non-controlled retained earnings. We laughed at the hubris of the princess and the toad syndrome. And finally, we found the purest definition of structural economic value in a single, hyper-efficient furniture store in Omaha.
It is a dense matrix of information to process, but the underlying unifying theme is incredibly consistent. You must train yourself to look past the surface-level accounting numbers to find the mechanical economic truth. And as we conclude, I want to leave you with a final provocative thought to mull over, building directly on our discussion of the insurance bond trap.
The zombie companies.
Precisely. We analyzed how standard accounting rules for amortized bonds allowed functionally insolvent insurance companies to hide their massive losses.
Yeah.
And we saw how that accounting illusion forced those companies into destructive cash flow underwriting, writing unprofitable business just to survive and keep the cash flowing, dragging the whole industry down with them.
Right.
It begs a profound, deeply unsettling question for the modern investor. Our global economy is exponentially more complex today than it was in 1980. Accounting rules have become more intricate, and financial engineering has become an art form.
Okay, where are you going with this?
How many massive household name zombie corporations exist right now?
Oh, wow.
Think about the tech sector, where massive valuations are often untethered from actual cash flow. Think about commercial real estate portfolios sitting on deeply underwater assets or capital-intensive green energy startups. How many of these companies are fundamentally economically dead, but are being kept alive entirely by the optical illusions of modern accounting? How many are surviving purely through constant refinancing or relentless infusions of venture capital that mask their true, structurally negative cash flows?
That's a scary thought.
Are we as modern investors critically analyzing the economic engine, or are we too just trading in accounting fictions waiting for the illusion to evaporate?
That is a terrifying and necessary question, and it brings us right back to where we started. When you look at the financial x-ray of your own investments or the company you work for, are you seeing a clean, precise picture of economic health?
Or are you staring into the diagnostic muddy waters, hoping that the jagged line isn't a fundamental break, but just a trick of the light?
Do not trust the surface of the balance sheet. Always look for the tapeworm, look for the iceberg, and look for the true economic reality. Thank you for joining us as the third mind on this deep dive. Keep questioning the numbers, and we will see you next time.